Let's bring in Michael Schumacher, Wells Fargo's head of macro strategy. Michael, great to have you with us. What was your main takeaway from the Fed today?
Yeah, the Fed's trying to spin the dovish hike. Really difficult to do. So the market's trying to figure out how to calibrate all these things. Higher inflation but coming down. Credit conditions tightening, which are already much tighter, by the way, over the last few months. So future tightening, I think, is on tap. And tie that into where the Fed goes, not so much today, but over the next 6 to 12 months. So I think this dovish hike narrative probably is not going to stick as much as the Fed might like.
What is your outlook for the economy, given the expected ongoing tightening in credit and also the variable lag effects of what the Fed has already done? I mean, we could be facing a powerful 1-2 punch when it comes to, a vice or some, the grit in the wheels of the economy.
Yeah, it's a good point. It weakens the economy a bit quicker than I think a lot of people expected. Interesting, the Fed's own dots show just a little bit lower expectations for growth this year than they had back in December. I think the Fed is not really giving enough credence to the idea that tighter credit means things weaken in a fairly quick manner.
Michael, if QT is responsible probably for about 25 bips of tightening, and this bank failure is probably equivalent, no one knows truly how much it is, but let's just say 50 bips, throw a number out there. You can correct me what you think. And then Powell hikes 25 bips. Is this too much to be hiking all simultaneously?
Well, as far as tighter credit and with respect to bank funds, you can't really tell at this point. And we got that sense from the press conference. At one point, Powell actually referred to guesswork. I would say it's a tough calibration. You just don't know. So it's hard to say right now whether the Fed has tightened enough or too much. And I think that's why the market's been bouncing around so much, whether it's the equity market or the bond market. People are trying to get a read on this.
But what are you telling clients, Michael?
We're telling clients as the Fed probably hikes one more time. Not a lot of confidence around that call. We'd be shocked if it were more than that, really. And when you think about the path for rate cuts, there's been this big gap between the market and the Fed for a long time. And currently, for the end of this year, there's about a 1 percentage point gap. So the market's saying, yeah, the Fed will cut a number of times. The Fed is saying, oh, no, we're not doing that. We'll stand pat. Probably the truth is somewhere in the middle. But really, we think the market's overreacted. So I suspect what you'll see is the number of rate cuts priced through December of this year diminishes. So instead of 75, 90 basis points, something like that, becomes something closer to 50 basis points. So that pushes up things like the 2-year Treasury and the 10-year Treasury yield a little bit.
Michael, in terms of positioning, especially for macro funds and folks, CTAs, I'm hearing a lot of data that they are so underweight the S&P. In fact, we're massive sellers of commodities and whatnot over the last week that, some part of this tells me, and when I add that to sentiment in markets, which, according to Bank of America is at 20-year lows in terms of sentiment, says that there's actually some risk to the upside. I know that's crazy given the kind of day we had today. Talk to me about positioning, about what you know to be the positioning of macro funds here.
Yeah, the clients we've been talking to over the last number of days and week or two really, I think, are torn. And they say, look, we do think it's near the end of tightening, whether it's the Fed, maybe the ECB, number of central banks on tap tomorrow. But it's really tough to call that turning point. And by the way, if the Fed stops tightening relatively soon, it's probably for a, quote, bad reason for risk, and that is that credit's gotten a lot tighter. So I haven't talked to too many clients who are super bullish on risk. When you look at the credit markets, corporate bonds, it seems like spreads could widen a fair bit. So I think that's really been tough for people.
All right, Michael, great to see you. Thank you. Michael Schumacher, Wells Fargo. So, Karen, do you look at your portfolio any differently than you did 24 hours ago?
Just thinking about that. No, not really. I mean, the mandate is to be invested in the market, so that makes it easy, right? And so I still have things like short HYG. I have banks, some long banks. Interestingly, to me, the HYG didn't move. I would have thought we would see, with the concern about credit, that we would see credit spreads widen, even though rates move differently.
I think you stay long the market again as a trader, and I think I'm with some of the other folks here that I don't think the market should be priced here. I don't think that the market has a lot of momentum on the earnings side. I think it's to the downside. But as long as the Qs outperform the SPYs, and that's what we've been doing all year, I think you have to stay long the market. Now, today may have changed that. This was an important Fed meeting, but that's what I'm waiting to see.
Yeah.
stopped right at the 200-day moving average. Guy mentioned the level before, 39.40. The 200-day moving average is a couple of points lower than that. But until the market breaks down on a technical basis, I'm with Tim. I think the risk is to the upside. I believe that's what you said, right? The market the risk is probably most likely to the upside still.
Yeah, and again, I would go back to positioning. Goldman had no doubt too. They talked about, again, CTAs, so commodity trading accounts, are at their lowest exposure on the S&P of all time. I mean, some of this stuff are, you can't have 3 standard deviation dynamics without at least thinking that there could be some risk to the upside.